What's up, everyone? Today we are going to be looking at another profitable trading strategy on the site TradingView.com. This strategy is going to consist of only one indicator, but the indicator has many moving averages that we will talk about now. If we can get to 1,000 likes on this video, I will do a step-by-step video on how I trade successfully, and how you can start becoming a profitable trader yourself, including all the transparencies and the tests it took to get to being a funded trader with a prop firm. But first, let's put this on our chart. Head over to the Indicators section in TradingView and type in Simple Moving Averages. Let's choose this one here, by Stocks in Box. As you can see, it has a lot of downloads, and is widely used by the trading community. When we add this onto our chart, the indicator already has built-in SMAs from all ranges. This includes the 20, 50, 100, 150, 200, 250, 300, 400, 500, and 600. Although the spread of these SMAs is so vast, it doesn't mean we cannot use it on smaller time frames too. For instance, today I will be using the 5-minute chart on Australian dollar to US dollar for our examples, and our back testing. But this indicator can be used for theoretically any time frame. Okay, let's run through some long examples for this strategy. But before we do that, let's explain what simple moving averages are. Simple moving averages are one of the most commonly used technical indicators in finance and investment analysis. They are a type of trend-following indicator that helps traders and analysts identify trends and potential price reversal points in financial markets. A simple moving average is calculated by adding together a specific number of prices and dividing by the number of prices used in the calculation. The resulting average is then plotted on a chart, creating a line that represents the average price over the specified time period. For example, a 20-day SMA is calculated by adding together the prices of the last 20 days and then dividing by 20. Traders and analysts use SMAs to identify trends, potential support and resistance levels, and to generate buy and sell signals. When the price of an asset crosses above its SMA, it is considered a bullish signal, while a price crossing below its SMA is considered bearish. The slope of the SMA can also be used to identify the strength of the trend, with a steep slope indicating a strong trend and a flat slope indicating a weak or sideways market. So without further ado, let's figure out how we can use this powerful indicator to set up long positions. Like I said before, bullish momentum is signaled by a cross above the SMA. But, as you can see with this indicator, there are a lot of SMAs to cross. So, for long positions, we require the candles to cross above all the SMAs. This will be shown when the SMAs turn green or blue. And once a candle has closed above all SMAs, we can take a long position. For this strategy, it is most effective if we set our stop loss at the heaviest SMA, that being the SMA 600. This is usually at the bottom, but it will always be the thickest green line, like here. And for this strategy, we target a risk-to-reward ratio of 1 to 2. This trade plays out well, but as you can see, the cross above all SMAs normally leads to a long-term uptrend, not always, but most of the time. The uptrend here lasted for several days. Okay, time for a short example. When it comes to short positions, we require the exact opposite of our long positions. We need the chart to break below all SMAs included in the indicator. And once this happens, this indicates a heavy downtrend for the future price. However, the stop loss for our shorts is very different to longs. Let me explain. When we take a long position, we are setting our stop at the SMA 600, which is the thickest green line on the chart. But for shorts, this is inadequate. We actually set our stop at the highest point of the SMA lines, which you can see is here. Our target risk to reward will remain at 1 to 2 regardless. This trade also plays out well. Okay. Now that we have run through a couple examples, I'm now going to back test the strategy 200 times and see what results we get out of it. Here are the results after my 200 trades. This test was done on the Forex pair Australian dollar to US dollar, 5-minute chart. This account started at $1,000, risking 2% per trade, which included compounding. The set risk to reward was 1 to 2, and the 200 trades took a lengthy 7 months to complete. Let's take a look at these numbers here. At the end of our test, the account ended with a total profit of $22,329, leaving us with a gain on account of just over 2,200%. Our win rate was 60.5%, and our best winning streak was 8, against a worst losing streak of 5. Keep in mind, this is just one simple indicator. And to produce results like that, just shows how powerful it really is. But one thing I noticed it lacked while testing it, was that it never really identified sideways trending very well. Yes, the SMAs do follow the overall trend of the market, but there are multiple times in the day when any market, including forex pairs, don't trend. This is due to a lack of volume in the market, which basically refers to the amount of people buying or selling. And when there are no buyers or sellers, there will be minimal price movement. There is only two things that control the market. That is fear and greed. During the opening and closing hours of the market especially, big banks or proprietary groups tend to buy or sell in vast quantities. This causes a huge spike of volatility, and possible chart gaps that cause a buying bias or selling bias. Keep in mind, this high liquidation can happen too when there is an important piece of news being released, like FOMC, for example. So, what can we do to identify the sideways trends better and incorporate it into our strategy? Well, we have several options. One way to help is that we can add a volatility indicator to our chart. To do this, go to Indicators in TradingView and type in VIX Fix. This is showing the index of volatility as a range starting from 0. Here, we can identify when the high volatility periods of the market are occurring, as well as the low volatility periods, which we should avoid, as these normally involve consolidation, which is not effective with our strategy. Another addition to our chart is possibly comparing our market product to the volatility S&P 500. To do this, we are going to need to add another tab on our desktop. After we have done this, let's change our tab to another product. Go to Product, and type in VIX. Let's choose this one here. As you can see, the VIX tends to display opposite trends to the chart. Remember, you should only compare the VIX to charts that are traded on either the New York Stock Exchange or the Nasdaq. Other products will not be compatible with the VIX. For example, the US 100 here is traded on the Nasdaq. If I typed in Tesla and added this instead, we can also see an opposite market open. Tesla has a huge gap upward, whereas the VIX has a huge gap downward. But how does any of this help us identify sideways movement? Well, as you can see, there is one thing that both the VIX and the American markets have in common. When they are both low volatility, the candles are extremely small ranging. When we can see a similarity in these small ranging candles, we should not be trading, as our strategy requires the market to be either strongly upwards trending or strongly downwards trending. However, if you do not wish to identify these candle similarities every time, there is another way. If you are unsure of the times of when markets open and close, simply look up when they do. And make sure that you know when they open, because this is when there will be a lot of volatility usually. I have personally never traded outside of the US market times, but it is a personal preference. But there is more. When we trade the markets, it is not just technical analysis we should be using, but also fundamental analysis. If you do not have a reliable source of information about the markets and the country they originate from, then there is a really good free website. The name of it is Financial Juice. This website only requires you to make an account, but once you have access to all the news from every financial market and how it will affect the market. This website will tell you the time of the news release, and the previous result, the forecasted result, and, when the time comes, the actual result. I have been using this website for almost 3 years now, and it has served me well. As you can see, I have set it to only give me the American news. And looking here, you can see why the American markets have been moving so much today. Many important news releases have dropped today, and we can identify which news drops are more important. The red indicate most important, and the yellow indicate least important. The blue indicate an important speaker discussing a financial topic or political topic. What all of these have in common is that they affect the market, no doubt. So I highly suggest you keep this window open when you are trading. It will help you improve, I promise. Anyways, I hope you have all enjoyed this video. If you are still here, thank you for taking the time to watch this video. I hope it has been helpful. Please consider leaving a like and subscribe, it helps me out loads. I will see you all in the next video. Good luck.